Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to journalist Liam Halligan, author of this week's cover story on The Spectator, The Next Crash, still available on newsstands. We could be on the brink of another financial crisis. What? Liam Halligan, welcome back to the Keiser Report.
Thank you, Max. Nice to see you.
All right, let's talk about this. George Osborne says the economy is recovered. So why do you say we're on the brink of another financial crisis?
Well, of course, we have seen a return to GDP at its pre-Lehman level here in the UK. It's taken the best part of 7 years. It's been the slowest recovery in British history, the slowest recovery in the G7. A lot of the recoveries built on more debt, of course, QE.
All right, so the GDP numbers are, on the surface, they look like things are recovering. We know that GDP is a very imprecise, sloppy, all-inclusive, not very interesting number because, for example, if you understate the actual inflation number, it makes the GDP look a lot greater. And we know that this government in the U.S. is constantly understating the true inflation number for things that are really necessities.
I'd say the main inflation metrics are understatements of reality, and I think most people in business and indeed running household budgets would agree with that.
So if you use that kind of number and you, as a deflator against the GDP, the nominal number, you end up with a real GDP that's a lot less robust. But
sure, and even in the UK, we have GDP per capita is still less than pre-Lehman, of course, because the population's increased and the nominal GDP has just got back to where it was.
Also, to make that GDP number bigger, did they just recently include drugs and prostitution?
Yeah, those changes are coming in. That's a kind of cross G7 phenomenon that will give GDP numbers around the Western world a boost. So what I'm arguing in The Spectator is there's a disconnect now. We are seeing some return to growth in the Western world, but financial markets are in a euphoric state. We just had a really important speech from the Bank of International Settlements following their annual report, where they pointed to a fundamental disconnect, that's a quote, between Western economic performance in Europe and in the US as well. Of course, GDP in the US on an annualized basis in the first quarter contracted, and yet we have the S&P 500 repeatedly hitting all-time highs. It's hit an all-time high about 25 times so far this year as it's ratcheted up and up and up, even though the US has failed to stage a particularly impressive and decisive sustainable recovery. And my problem with the situation we're in is, Max, that a lot of these asset prices are built on momentum. They're built on printed money rather than fundamental improvements in business and commerce across the Western world. And we're in a slightly different position from pre-Lehman, of course, because after the Lehman crash, the emerging markets tended to act as a bulwark, a source of stability. On the quiet, a lot of the big emerging markets helped with the Western bailouts. We didn't like to admit it, but they did. But this time, again, because of QE, you've got debt markets in the emerging markets that are pumped up as well, bubble-like tendencies, the so-called fragile five, but it goes beyond that across the big emerging markets. So the emerging markets themselves could be a source of systemic instability as we have in the Western world as well.
Let me describe the last few years. Tell me if this is a good description. In 2008, you had credit seizure around the world. Credit dried up. Yeah. Banks were at the threat of going bust. And in response, central banks engaged in quantitative easing, and you had very loose monetary policies. Here in the UK, the debt under Osborne roughly doubled. The national debt.
Yeah, more than that now. More than that.
So
we're about 1.25 trillion pounds.
So he added roughly 600 billion pounds in debt.
Yeah, so, and counting. It'll be about 1.6 by 2018-19 on Treasury numbers, 1.6 trillion pounds.
So the credit card was cut off in 2008, essentially, when banks' credit froze. And instead of attacking the systemic problems, the central banks came in and they figured out a way to open up the credit levers again. And in this country, they simply doubled the amount of debt that they've gone into. They're in much more debt, historically, maybe even the highest debt that they've been in.
A lot of that debt, of course, bought by our own Bank of England, just as in the States, but particularly in the UK, we've had circular financing of government debt. It's practically unprecedented in peacetime in this country.
So is that part of the systemic crisis that you see kind of falling apart in the near future?
Absolutely. Obviously, we had big government bailouts of our large banks post Lehman. This time round, governments are in a much, much weaker position. Even on the basic metrics, Western governments now, on average, have debt to GDP ratios of about 275%, according to the Bank of International Settlements. It's not the official numbers, it's all the other stuff, the hidden liabilities that I know you talk about a great deal, compared to 250% pre-Lehman. Plus, we've got this situation where sovereign debt markets, particularly of the US and the UK, increasingly the Eurozone too, are basically rigged, popped up by printed money. That, of course, is a source of systemic instability.
In the US, GDP has fallen sharply.
Sure. In the first quarter, there are signs it will recover a bit. In the second quarter, we don't know the figures yet. But what was interesting to me, Max, and I'm sure to you as well, is when the really bad GDP numbers came out in the first quarter, the markets loved it because bad news is good news. That meant the Fed was more likely to take its foot off the gas in terms of tapering, if you like, to turn up the funny money dial even more. So bad news is good news. What a situation we've got in. The markets rally when there's bad news because it's more likely the biggest central bank on earth will print more virtual money. So that's why stock markets, in my view, are rigged. There are a lot of mum and pop investors out there trying to invest their nest eggs, trying to get their kids through college, who aren't aware of these things. A lot of the financial services industry aren't talking about it, even though they know it. And what I've tried to say in this Spectator article, and it's not mainstream publication, is look at the metrics of things like volumes. Trading volumes are very, very low. Valuations are very, very high. That's classic crash territory. Then also you've got margin debt being taken off the table rapidly now. So the big sophisticated investors who borrow to invest, they're deleveraging themselves because they know this is a story that's looking increasingly implausible, even though people are still banging the drum and telling everybody they have to buy into this market.
Okay, you're hinting at this becoming more of a global crisis because unlike in the 2008 where the Asian or the emerging economies kind of picked up the slack.
They did.
They now are in a similar situation. And so now we enter into a similar pre-crash scenario where the bank's capital is highly questionable, where the collateral is highly questionable. The Bank of International Settlements that you referenced, that's the central bank of central banks. They are warning about what's happening in these markets.
And they're being dissed by the central banks themselves, just as they were in 2006, 2007. But there's some things, I am hinting at all that. In emerging markets, I don't think you've got equity markets pumped up. I still think a lot of emerging market equity markets are undervalued. But their debt markets are pumped up largely because money's been extended from Western financiers, QE money, some of it in a desperate search for yield, given ZERP and NERP and so on, very, very low interest rates here in the Western world.
And when you look at the global picture, the global banks, the global central banks, there is now unmistakably a lot of collusion that goes on between all these banks. For example, when Janet Yellen has talked about tapering, we know that the ECB has increased their quantitative easing substantially.
Covertly. And there's a lot of, be in no doubt, even though they don't like to talk about it because the German public goes mad because of its historic inflation aversion for good reason. The ECB's balance sheet has doubled in the last 3 years, even though they haven't had overt QE, they've had covert QE. Mario Draghi is now pushing for overt QE precisely to try and beat America and the UK at its own game by visibly debasing the euro in a sop to Eurozone exporters.
So in 2008, the global debt to GDP was around 310%. Today it stands at close to 320% debt to GDP. So despite all this talk of austerity, despite all this talk of cleaning up the situation, the debt is actually higher. Now you quote in this article, in the Spectator, get a good look at it, run out to the newsstand right now. Make Andrew Neil happy. I think he's one of the publishers of this.
Andrew is the publisher of the Spectator.
Yeah, Andrew. Right. See, we're helping. You quote Professor Michael Dempster.
Yeah, of Cambridge University. Yeah.
He says that derivatives, now the derivatives is the glue that ties all these global banks together. This is my question. I'm leading up. I'm leading up. You say derivatives are now all about creating confusion to hide losses. Sounds like fraud. So this is my big question of this interview. Everything we've said up until now, global banks, the crash is coming again, there was no reform, George Osborne just doubled the debt, he didn't do jack, beep, okay? And it's all tied to these derivatives, global derivatives it's just about hiding losses. Talk about that.
Well, in theory, derivatives are entirely legitimate things to use. Farmers have used derivatives for centuries. It's the way you legitimately hedge risk. But according to Michael Dempster, many other expert observers, many regulators, when they're off the record, derivatives are increasingly used in order to obfuscate, to create a lack of clarity across bank balance sheets.
Yeah, but for every dollar of oil that trades in the physical oil market, there's $60,000 worth of derivatives trades. That's not just hedging the price of oil. That's not for an oil producer hedging. That's rank speculation on an enormous scale.
I don't think anybody serious would disagree, if they're being honest, that of course an awful lot of what happens in the financial services industry has very little to do with actually providing services, financial services, to the broader world of commerce.
Would it be a stretch to say that if you're looking for a global crash, that it would basically be a popping of this derivatives bubble? And if so, where would that pop happen? Where is that one spot of vulnerability, if you can identify that?
Of course, if I knew that, I wouldn't be sitting here, Max. What I would say, though, is that the total volume of outstanding derivatives across the world, according to Michael Dempster and many other expert observers, is now bigger than it was pre-Lehman. I'm also saying that the amount of subprime loans that are being extended are bigger than pre-Lehman. I'm saying government debt is bigger than it was pre-Lehman. I'm saying that Western equity markets are very overvalued on historic criteria, and also emerging market debt prices are very overvalued.
Okay,
there are bubbles everywhere, any one of which could cause be the spark that causes a systemic issue. And
in other words, there's an avalanche coming. You just know which snowflake is going to start it.
You could,
okay.
And I don't want it to happen. I'm not willing it to happen. I'm just saying that we're not putting near enough attention on the fact that it could happen. And then sitting underneath all this, lurking in the undergrowth, if you like, are the too big to fail banks. And I actually think that's the really strong part of what Professor Michael Dempster and also Professor Anat Admati of Stanford University were saying in my Spectator article. They were saying the too big to fail banks have not been reformed. Very little has been done to actually lessen the systemic risk that they pose. The combined balance sheets of the big six biggest Western investment banks are bigger than they were pre-Lehman. A lot of the reforms that are coming in are weak and don't come in for many years anyway, so the banks still pose a big systemic risk. Even though the politicians are telling us that too big to fail has been solved, it has not been.
All right, we got to cut it there. Liam Halligan, thanks so much for being once again on the Keiser Report.
Thank you.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Liam Halligan, author of this brilliant cover story in this week's Spectator magazine.
I'm not paying, honest.
The next crash. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.